By the end of this video, you will know exactly how to choose between growth stocks and value stocks for your specific financial situation, and you will have a crystal clear framework you can use to build a portfolio that actually matches your goals, your timeline, and your risk tolerance starting today. Here is a fact that might shock you. Over the last 20 years, there have been entire decade-long stretches where growth stocks absolutely crushed value stocks, and then entire decades where value stocks dominated so completely that growth investors wondered if they had made a catastrophic mistake. The difference in returns during these periods was not small. We are talking about hundreds of thousands of dollars in difference on the same initial investment. So, which one should you actually buy? That is what everyone wants to know, but before I reveal the one strategy that legendary investors use to never have to make this choice at all, a strategy that most financial advisors never tell their clients because it requires them to admit something uncomfortable about the entire industry. Let us start with what these two investing styles actually mean and why picking the wrong one for your situation could cost you a decade of progress toward financial freedom. In this video, you are going to learn 3 things that will transform how you think about stock investing forever. First, the precise mathematical difference between growth and value stocks, with real numbers so you understand exactly what you are buying. Second, the hidden psychological trap that causes 80% of investors to pick the wrong style at exactly the wrong time. And third, the specific portfolio framework I use that removes emotion from the equation entirely. Quick, if you have ever felt confused about whether to buy high-flying tech stocks or steady dividend payers, hit the like button right now. It tells the algorithm this content is valuable and helps us reach more people who need this information. Let me paint a picture of the frustration I hear constantly. You finally decide to start investing seriously. You have saved up $10,000, maybe $20,000, and you are ready to put your money to work. So you open your brokerage account and suddenly you are staring at thousands of stock options. You see Tesla up 400% one year, then down 60% the next. You see boring utility companies barely moving but paying steady dividends. You read one article saying growth stocks are the only way to build real wealth, then another article the same day saying value investing is how Warren Buffett became a billionaire. So you freeze. Or worse, you chase whatever performed best last year, buy at the peak, watch it crash, panic sell at the bottom, and lose 30% of your hard-earned savings in 6 months. This is not hypothetical. Studies show the average investor underperforms the market by nearly 4% annually, and the primary reason is buying high and selling low because they do not understand what they actually own. 4% per year might sound small, but over a 30-year investing career, that gap means the difference between retiring with $1.2 million or retiring with $500,000. Same income, same savings rate, $700,000 left on the table because of one fundamental misunderstanding. But here is what nobody tells you. The growth versus value debate is largely a false choice created by an industry that profits from your confusion. Let me explain exactly what I mean. Growth stocks are companies expected to increase their earnings at an above-average rate compared to the overall market. Think of companies like Amazon in 2010, Netflix in 2013, or Nvidia in 2020. These companies typically reinvest all their profits back into the business rather than paying dividends. They trade at high price-to-earnings ratios, sometimes 50, 80, even 200 times earnings, because investors are betting on future growth. Here is a concrete example. If you had invested $10,000 in Amazon in January 2010, when it was considered an expensive growth stock trading at over 60 times earnings, that investment would be worth roughly $450,000 today. The people who said it was overpriced missed one of the greatest wealth-building opportunities in stock market history. But here is where most people get this wrong. They look at that Amazon example and think they just need to find the next Amazon. So they buy a dozen speculative growth stocks, hoping one becomes a 10-bagger. The problem is that for every Amazon, there are hundreds of growth stocks that went to zero. Remember Pets.com, Theranos, WeWork at its peak valuation? Growth investing is not about gambling on lottery tickets. The actionable fix is this: only buy growth stocks where you deeply understand the business model and can articulate specifically why revenues will compound for the next decade. If you cannot explain it in 2 sentences, you do not understand it well enough to own it. Value stocks are the opposite end of the spectrum. These are companies trading below what their fundamentals suggest they are worth. They have low price-to-earnings ratios, often under 15. They frequently pay dividends. They are typically mature businesses in established industries. Think banks, energy companies, consumer staples, utilities. Here is the value investing pitch in real numbers. From 1926 through 2006, value stocks outperformed growth stocks by an average of 4.4% annually. That academic research made value investing look like free money. Investors piled into value strategies expecting easy outperformance, but here is what nobody tells you about that data. Stop. Before I continue, this next part is critical. From 2007 through 2020, growth stocks beat value stocks by such a wide margin that many value investors abandoned their strategy entirely, right before value made a massive comeback in 2021 and 2022. The mistake 80% of people make is treating these historical statistics as guarantees. They see that value outperformed over some historical period, assume that pattern will continue, and bet everything on that single outcome. The actionable fix is to understand that value and growth leadership rotates in cycles that can last 10 years or longer. No one can consistently predict when these rotations will happen. If anyone could, they would be the richest person on Earth. Let me give you the specific numbers that separate growth from value because most people have never actually seen these metrics side by side. A typical growth stock might have a price-to-earnings ratio of 40, a price-to-book ratio of 8, pay 0 dividends, and show revenue growth of 25% annually. A typical value stock might have a price-to-earnings ratio of 12, a price-to-book ratio of 1.5, pay a 3% dividend yield, and show revenue growth of 4% annually. This next section changed everything for me when I finally understood it. The difference between growth and value is not just about numbers on a screen. It is about what kind of return you are expecting and when you expect to receive it. Growth investors are betting on capital appreciation far in the future. They accept 0 income today in exchange for potentially massive gains in 10 years. Value investors want returns now. They want dividends depositing into their accounts quarterly and modest but steady share price appreciation. Neither approach is wrong. They are just different tools for different jobs. Here is where most people get this wrong. They pick growth or value based on which one performed better recently, instead of asking which one matches their actual life situation. If you need income in 5 years for a house down payment, speculative growth stocks are the wrong tool. If you are 25 with a 40-year horizon and 0 need for current income, loading up on dividend stocks means sacrificing enormous compounding potential. If you have made it this far, you are already ahead of 95% of people. And what I am about to share in this next section is the most valuable part of this entire video. Do not skip it. Subscribe to @WealthDecode Plus if you have not already. We drop a brand new money strategy every single day at 6 p.m. Hit that notification bell so you never miss one. Here is the psychological trap that destroys most investors. And I need to pause here because this is where most people go wrong. It is called performance chasing, and it is hardwired into your brain. When growth stocks are soaring, financial media runs constant coverage. Your coworkers brag about their Nvidia gains. Your social media feed shows screenshots of massive profits. Your brain releases dopamine just imagining those gains in your account, and you feel an overwhelming urge to buy growth stocks immediately. Then growth crashes while value quietly outperforms. Suddenly the narrative shifts. Experts declare growth investing dead. Your brain, desperate to avoid more pain, wants to sell all growth and buy value. This is exactly backwards. The academic research is clear. The best time to buy growth is when growth is hated. The best time to buy value is when value is ignored. But your emotions will scream at you to do the opposite. The specific fix is to write down your investment strategy when you are calm and rational, then commit to following that plan regardless of what markets or media or your emotions tell you to do. Most people skip this step. Do not be most people. Let me share the specific framework professional investors use. Instead of choosing between growth and value, they own both in proportions that match their goals. A balanced approach might be 50% total market index funds, which automatically include both growth and value in market weight proportions, 25% tilted toward growth through a growth-focused index fund, and 25% tilted toward value through a value-focused index fund. This is not exciting. It will not make you rich overnight. But historically, this balanced approach has captured most of the upside of both styles while reducing the gut-wrenching drawdowns that cause investors to panic sell. Here is the real math. An investor who put $10,000 in a balanced growth and value portfolio in 2000 and earned 7% average annual returns has around $76,000 today. An investor who tried to time the switches between growth and value but got it wrong by just 6 months each cycle might have $40,000 today. Same starting amount, same time period, $36,000 difference purely from trying to be clever. Now here is what you should do today. This takes 10 minutes or less. Log into your brokerage account and calculate your current growth versus value exposure. Most brokerages show this automatically in your portfolio analysis. If yours does not, take your 3 largest holdings and search their ticker symbol plus the word Morningstar, which will show you whether each is classified as growth, value, or blend. Write down your current split. This week, define your target allocation. Consider your age, your timeline, and your income needs. A simple starting framework is to subtract your age from 110. That number is your stock allocation, and within that, consider splitting roughly evenly between growth and value, unless you have a specific reason to tilt one direction. This month, set up automatic rebalancing. Most brokerages offer this for free. Set it to rebalance quarterly, which removes emotion from the equation entirely. The specific free tools I recommend are Personal Capital for tracking your overall asset allocation across multiple accounts and Morningstar Instant X-Ray for analyzing exactly what is inside your funds. Both are completely free and take minutes to set up. Now let me answer the question I planted at the very beginning, the strategy most financial advisors never tell their clients. Here it is. The entire growth versus value debate becomes irrelevant when you own the total stock market through a single low-cost index fund. One fund, 0 decisions. Automatic exposure to growth when growth leads and value when value leads. Financial advisors rarely recommend this because there is nothing to sell, no active management to justify fees, no complexity to make you feel like you need their expertise. The uncomfortable truth is that a single total market index fund has outperformed 89% of professional fund managers over the past 15 years. You do not need to pick between growth and value. You need to pick low costs, broad diversification, and decades of patience. Here are your 3 key takeaways. First, growth stocks prioritize future capital gains, while value stocks prioritize current income and margin of safety, and neither is inherently superior. Second, the biggest mistake is switching between growth and value based on recent performance, which is the exact opposite of what actually works. Third, owning the total market through low-cost index funds removes the need to choose and has beaten most professional stock pickers. Comment below and tell me which of these strategies are you going to try first. I read every single comment and I will personally reply to as many as I can. In tomorrow's video, I am revealing the exact index fund portfolio I personally use and exactly how I rebalance it, something that took me years to figure out and most people never learn. Subscribe right now so you do not miss it.